Hopefully you had a wonderful weekend, and hopefully you have a good week coming up here with weather-wise. So we'll get started here. Last week's moneymaker was what do you do when people aren't returning your emails? Make sure you have a subject line that will grab their attention. So I gave you some examples of subject lines you can use there. You should save that and use that as kind of an idea starter when you need to send those emails. Tape breakdown. These people are arguing about whose fault it was for hiring a bad advisor. If you want to know how the 5Q system will work for you if you do it right, when you got a husband and a wife blaming each other for the bad advisors that they hired, guess what you have? So let me get some answers to that question. When a husband and wife are arguing about who was responsible for the bad advisor that they had, yeah, you got new clients. That's right, Shane. so that's that tape breakdown was just to let you know, dudes. This is and the funny thing is, if you listen to it, these folks have a really thick accent. So guess how good that advisor was. I mean, obviously he's communicating really well for people with a thick accent to still understand well enough that, you know what, that advisor we were working with is a crappy advisor. So, for those of you going through the tutorials, we've added checkouts now. So there's just like a little 3 or 4 page, 100 question. No, it's 3 or 4 questions per checkout that you can check out to kind of let you know that, hey, I got the gist of what we're trying to do here. Now, do you think that test is the object here with this test to check out of that test, or is the object to memorize the script? I mean, we all were at school where what we would do when we were given an assignment with an open book test, what would we do? We simply skim through the book to find the answers and then moved on. No. This is just like a spot check to make sure you get the big picture, but this is not to replace memorizing the script. Yeah, Jeff, it's for memorizing. Okay, 5Q tips, lots of tools. Oh, so you're going to be receiving some tips coming, going forward here and there. Just to remind you, guys, is our website sparse or is our website robust? So there's so much stuff on there. It's even, Missy and I will be amazed that we'll forget tools that we had that we've been using 5 years before because we add new tools and things like that. So what I've decided to do is just send you tips just to remind you about maybe some things you had forgotten exist on the website. So you'll be getting those on an occasional basis. Is that an okay thing? Do you think that's going to be, we send them out every week, 2 weeks, once a month? Are you okay with that kind of stuff? Just getting reminded of, so it doesn't seem like you're getting blasted with too many emails? Good, everybody's saying yes. Good, super. And then thanks, Mark. Mark sent this in an article about Morgan Stanley drops Vanguard mutual funds and is now using their own indexes. So what does that tell you guys? It tells you 2 things. What does that tell you? Low cost is here to stay. I'd agree with you, Jeff. Indexing is on the rise. Wade, I'd agree with that. So lower fears are coming, right, Mike? So here's the thing. So many people were investing in Vanguard funds, and Morgan Stanley said, we need to figure out, we're just going to use our own funds. Because first of all, we're not making much money when the people are investing in Vanguard. Second of all, so many people are doing it, we want in on that. So this is an indicator of what's to come, which is people are going towards indexes, and that ain't going away. That is not going away. I saw this markets fear gauge. Those of you who are familiar with the VIX index, which is the volatility index, says investors are sanguine, which means they're happy about the stock market as they have been in almost a quarter, are more happy or more relaxed about the stock market than they've been in almost a quarter of a century and in 25 years, according to one indicator, which is the VIX. Despite months of global turmoil showing comfort in strong corporate earnings and signs that the job market is humming. So things are great, right? Contrarian time, Mike, you got it. Hello, correction, right, Steve? So, that's my response. Because here's the thing. Everybody's saying about corporate earnings. Let's talk about strong corporate earnings. Who here is familiar with the CAPE, the Shiller ratio, the CAPE ratio? So the CAPE ratio, it takes an average of the PE for over the last 10 years. Look at where the CAPE ratio is right now. So should we be saying, so when they're saying corporate earnings are terrific, what does it say about corporate earnings right now? So I don't know what the hell corporate earnings are looking at. And do you think corporate earnings are going to, going up or going down right now? Because consumer confidence is way high. It's interesting. Consumer confidence is way high. Guess what's happened to consumer spending over the last 4 months? It's down, right, Dave? It's down. So again, I don't know what's going to happen with the market, but is this an indicator that we're near the beginning of the bull market? Or, oh my gosh, we need to be on the watch? Also, indices look swell, but danger lurks underneath. So those of you that understand how the markets work, right before a bear market, we see a great market surge. And you look at all of the market, and you look at the Dow, you look at the S&P 500, and they're doing really well. But when you look at the Dow and you look at the the S&P 500 is doing really well, where's an indicator that maybe it's not as good as it's supposed to be? Does anybody know? Volume, Jeff, you got it. And specifically volume, but more importantly, what's happening with most of the other stocks underneath. See, here you go. The challenge for the market now is that it isn't doing a very good job of putting together sustained momentum. There's a 2-day rally a couple of weeks ago, but then the buying slowed on poor breadth and weak action in small caps. So it gave back all the gains. So what we're seeing here, the dilemma is the stock market right now is that the technical condition of the indices is quite good, but there are a number of negatives under the surface of bubbling up. The biggest issue has been that the few big caps have covered up quite a bit of the underlying weakness stocks. This is where you start to see the danger in the market is that when, because S&P 500 and the Dow, it's weighted, right? You understand that it's weighted. So those big stocks, if they're doing well, they will hide the weakness of all the other stocks underneath it doing poorly. So the average stock market has been correcting. The average stock has been correcting, although you wouldn't know it from the indices. So you look at the indices and it says the Dow and the S&P 500 is going up, but the average stock, most of the stocks then are correcting or down. Almost 40% of the stocks are under their 200-day simple moving average of price. 46% are under their 40-day. So this is an unusual level of weakness for a market that is setting all-time highs. So do you guys get that? A few stocks, the big ones, are doing well, but the vast majority are not doing well. What does that bode for the stock market? Not well. That's what it bodes. It bodes not well. And then as soon as you start, seeing magazines saying, "Hey, stocks are the place to be," what do we know? There's the old adage about what? When you're in the cab and the cab's giving you stock advice, guess what? Time to get out. Now remember, I showed this to you about 6 months ago. When we hit the high, 20,000, we hit a new high, and here's the round numbers that we hit in the past. So we hit the round number of 100. We hit that in 1933. Oh, sorry, we first hit 100 in 1906. Guess when it came back? 1933. It took 18 years. First time it hit 200? Took 18 years to get back. First time it hit 1,000? Look at, hit 1,000 in 1966. Look at how long it took to get there again. Do you understand what I'm saying here? It hit 1,000, and then it went down, and it meandered around, and it didn't hit 1,000 to, and then leave 1,000 forever until 1982. So it hit 100 in 1906, and then it went down, and it meandered around until finally in 1933 it hit 100, and it never looked back. Do you guys get what I'm saying here? 10,000. It first hit 10,000 in 1999, and then it went down, and it didn't leave 10,000, hopefully for the last time, until 2010. So when the market hits those big round numbers, guess what happens? 100, 200, 1,000, 10,000, what happens when it hits those big round numbers? There's a correction, and it takes a long time for it, then it meanders down, and then it comes back up, and it takes a long time to come back up to that round number again. So we've hit at 20,000. Guess what that's an indicator of? Oh my gosh, that's what it's an indicator of. Now, last week, a lot of you guys said, like, geez, I think 40 some guys told me that they weren't aware of the fact that stocks generally don't keep ahead of inflation, and you wanted me to go back and show you that information again. So when I was pulling up that information, I found an old presentation that I'd done and updated so you can kind of see it's part of that, so you can see these things that we're dealing with right now. So guys, if you know these 10 secrets about the Wall Street, guess where that's going to put you as compared to all your competitors? Now, are you going to whip out this presentation for your client? No, but can you put it in your toolbox in case you want to pull a tool out here and there? Yes. And here's the funny thing. If I want you to answer this question. So I'm going to ask you this question at the end of this presentation. How many of these 10 things, if I was to give a quiz to the average advisor, how many of these 10 things would the average advisor be able to answer correctly? Okay, so I'll ask you at the end. What? You can't give me that answer yet, Dave. So, wait for me to give you these things, and then you tell me how many the 10 that they'd be able to answer correctly. So first one, I don't want you to know about any of the fees, but especially about the hidden fees. According to a study done by Wake Forest University and University of Florida, the 30 largest mutual funds would have had to increase their published expenses by 43% if they included the hidden fees caused by turnover. So our managers and mutual funds and variable annuities, are they required to report turnover costs in their prospectus? No. And that's what we do with the 21-point checklist, right? So this is, you've done a lot of 21-point checklists. Jeff, does this jive with all the Morningstars you've done in the last 17 years?
Oh yeah, turnover, if you do these proposals, the software will calculate the dollar amount for you. It's almost always nearly as high as the actual cost.
Yep. So 43% is actually low, right?
Yep.
Number 2, stocks don't necessarily keep ahead of inflation. This is the one that you wanted me to show to you, okay? So let's walk through this. What happened in 2000 and 2016? Well, let's take a look at it. Here's the Dow. In 2000, the Dow was at 11,000. January of 2016, it was at 16,466. I don't know why that high-low is there. I'm not sure why that's there. So in 2000, it was at 11,000. In 2016, it was at 16,000. So that means over 17 years, it averaged 2.5%. Does that put it ahead or behind inflation? I want a bunch of answers on this. Yeah, I'd say behind to equal to. More likely behind. Okay, so that's the Dow. But Mike, people don't invest in the Dow. The S&P 500. 1,517 in 2000. 1,940 in 2016. It averaged 1.64 per year. So now let's answer this. Now can we answer, was it ahead or behind inflation for that 16 years? This one, there's no Dow, right? Well, let's go to the NASDAQ. It averaged a loss of 0.1% a year for 17 years. Is that ahead or behind inflation? Steve, pardon my French, but fuck you. So Steve brings up this thing. Everybody always brings this up. Well, what about the dividends? Well, fuck you. You know why? Why don't I include the dividends on this, guys? Why don't I include the dividends on this? Steve, are you investing for your clients at no fee? Are your managers investing at no fee? Huh? Are you? So then guess what? Guess what comes out in the wash? When somebody throws out dividends, it pisses me off. Why does it piss me off? Because they want to have it both ways. They want to say, well, look, it's not keeping up with dividends, but then they don't want to add their fucking fees into it. So, am I clear? Am I clear? Are we ahead of inflation or not ahead of inflation? Okay, so for 16 years, ahead or behind inflation. So stocks don't necessarily keep you ahead of inflation from 2000 to 2016. That wasn't the only time. For 17-year period, 1965 to 1982, the value of the dollar dropped significantly. What $100 bought in 1965 would have cost $311 by 1982. And yet $100 invested in the Dow in 1965 would have been worth only 97 by 1982. So did that keep ahead of inflation? No, it lagged inflation by how much? So let's do the math here. 1965 to 2016, guys, how many years is that? 17 years, 1965 to 1982, 17 years, 2000 to 2016. How many years does that add up to? So 34 of the past 51 years, 67% of the time, the stock market did or did not keep up with inflation. I want everybody to answer this. And you know what? I'm going to look at this, and anybody who doesn't answer this, guess what I know about them? They probably do assets under management. So guess what? I'm going to wait on here till everybody frickin' answers this question. So Steve, what do you mean by yes, Steve? That yes, it did keep up with inflation, or yes, it did not keep up with inflation? Help me out. Thank you. So, guys, how many advisors know this? Yeah. Just think with this information, if this information was on the Wall Street Journal, what would happen to assets under management? What would happen to the stock market? Because why do people invest in the market? It's supposed to keep you ahead of inflation. Yeah, you know what, folks? You got to take all the risk that the market has, and you know what? 1/3 of the time, it'll keep you ahead of inflation. What are they going to say to that? Average rate of return is a big fat lie, as we know. We have that in our presentation, right? Because of sequence of returns. So average rate of return for our clients. Why is this important for our clients? Why is this an important fact for our clients? All of you are coming up with good, very, very good rules, but the biggest problem is it's because of when we pull out, sequence of returns can kill our clients, right? Sequence of returns can kill our clients and their portfolios. Number 4, if you stay in the stock market for the long haul, you'll be okay. Here's how I know that's BS. If this were really the case, brokerage houses could double their profits. If brokerage houses really believed that this was the case, they could double their profits. Throw me out some numbers that people use for staying in, when they talk to their clients, staying in for the long term, in years. Give me some numbers in years that brokerage throw out for staying in for a long time. 10, that's what most people use, 10, 10, 10. So let's think about this. They presently make 1% per year on expenses, right? Can we say that's about average, 1%? How many of their clients would want a guaranteed 6% rate of return for the next 10 years? So let me see. Yeah, all of them would, right? If you went to your client and said, how would you like a guaranteed 6% rate of return for the next 10 years? How many of your clients would say they'd want that? Okay, well, if that's the case then, and advisors know that for the long term, you know, they're going to be great. So here's the thing. Why doesn't a brokerage house then, if they know that, if they're not making a claim that their stock accounts are going to make more than 6% a year, they're making a claim that their stock accounts are going to make more than 6% a year, why don't they go ahead and guarantee the 6% to the client? If they know over the next 10 years the market's going to average 8% or 9% or 10%, they could double, triple, or quadruple what they make on it. I mean, it's no law, you know, it's no, you know, stay in for the long term. Hey, the market's going to make you 7, 8, 9, 10% on average over the next 10 years. Should, you know, why not do that? So why don't they do that? Heck, how many of your clients would lock in 5%, for the next 10 years if you offer that to them, or even 4% over the next 10 years if you offer that to them. So if the brokerage only thinks it's going to make 6%, why don't they go out and offer 4% guarantee for 10 years? They'd still get how many billions of dollars? They'd probably get $1 trillion. So if that's the case, why don't they do it, guys? Why don't they do it? Why don't they make that offer? Because do they believe that you're going to be okay if you stay in for the long term? The brokerage houses really believe. How about asset managers? All you asset managers, are you making this claim to your clients? The client is happy with a 6% rate of return, 5% rate of return, 4% rate of return, and the manager could double, triple, or quadruple their return. It's all smoke and mirrors. I agree with you, John. So why don't they offer it? Because they have no clue what the market's going to do over the next 10 years. If they don't know, then, guys, if you don't know what the market's going to do over the next 10 years, what kind of claim should you be making about how much the market's going to make over the next 10 years? So remember, what do I tell you as an asset manager you should say to your clients? If the market goes up, you're going to what? Go up. If the market goes down, you're going to what? Go down. And in history, more often than not, the market goes up. Can I stand by those claims? How much are those, if I'm an asset manager, can I be 100% certain when I say, hey, when the market goes up, your assets are going to go up. When the market goes down, you're going to go down. And most times in over history, the market has gone up more often than down. Can I stand by 100% those claims? But if I start throwing out freaking numbers, then I better what? If I start making claims that I'm going to go down less than the market or go up more than the market, now can I stand by those claims? If you're going to turn over your house to your clients if you are wrong, then go ahead and make those claims. How many of you would give up your house if your other claims didn't come true? Yeah, you better bump up your E&O insurance, right, Cheryl? Number 5, my guy is not the best. How do we know your money manager isn't the best, guys? There's one test to this. How do we know your money manager is not the best? More than one, I would agree with that. Yeah, there's thousands of money managers. I'd agree with that. That's one of the answers. The other is this. If he was really the best manager, what would his minimum be? Yeah, 50 million, 1 billion, that's what his minimum would be. Now, hopefully you guys, would the minimum be $1 million if he was the best money manager, guys? I've got some people saying $1 million. No, it'd be 50 million, it'd be 100 million. That would be the minimum he'd have. So if your money manager is taking 250,000, 500,000, or $1 million, guess what I know about him? He ain't the best. And there is no best money manager. Past performance is no guarantee of future performance. This is a real thorn in my paw. Guys, you know, it's hilarious that VAs and mutual funds and money managers, they throw out their frickin' mountain chart, and then at the bottom it says what? Past performance is no guarantee of the future. Why? What's bigger? Is this past performance is no guarantee of future performance? Is that bigger or smaller than the mountain chart that they show? How much smaller? A lot smaller. So, you know, this is where FINRA and all those guys, it just makes me laugh. They're not trying to protect the public. If they're trying to protect the public, how big should this be as compared to the mountain chart? You know, it's supposed to be balanced, aren't they? Isn't FINRA all about a balanced presentation? Aren't your compliance officers all about a balanced presentation? Well, if there's a balanced presentation, then how big should this past performance is no guarantee of future performance be as compared to the freaking mountain chart? Should be at least equally the same size, right? They talk the talk, but don't walk the walk. If they really believe this would throw away their mountain charts and tables showing past performance and the necessary verbiage in small print, or they at least make that small print as big as the mountain chart. There is a reason I've mistitled your accounts. We all know about that, right? That's what we do with the 20-point checklist. The actively managed accounts do not beat the index regularly enough to validate paying fees. There's how much information is there out that validates this, guys? I mean, I could spend the next 6 months of coaching calls validating that actively managed accounts do not beat indexes and certainly not enough to validate paying fees. Warren Buffett, where does he recommend when he dies, what's in his will? Where does he say his wife, LeBron James, and you and I should put our money? Yep, indexes. And again, I could go forever and ever with all sorts of, Jeff, how much information do I have on the fact that indexes kill managed money?
Oh, tons. I mean, and you don't have to go far. If you looked at any study or investment news, you'd see that weekly.
Yeah, and it's interesting. Any university, any economics department, any finance department, they always show 100% of the time that indexes beat actively managed. Who are the people that manipulate the information to show that actively managed beats indexes? It happens to be some Wall Street firm. Investment companies, exactly, Wade. Number 9, I would prefer that you don't know about the preferred list. We all know entities such as Edward E. Jones, they don't have a preferred list, do they? Ken Fisher, not Ken Fisher, who's the other? Oh, Dave Ramsey, he doesn't have a preferred list, does he? Guys, are there entities out there that push a particular mutual fund? Yes. 10, they can't make you happy, but they can certainly make you unhappy. Money doesn't make anybody happy as long as you have enough money to live comfortably. Connections make you happy. So they found over and over and over, does money make you happy, guys? No. The number of connections you have with family, friends, organizations, that's what makes you happy. Getting a 30% rate of return makes you excited, but it cannot make you happy. Guys, if you get somebody a 30% rate of return, what do they say? Why isn't it what? 32. Yeah, why isn't it 40? So the other thing is, guys, if you get a 30% rate of return, but their life is gone in the crapper, is that 30% rate of return going to make them happy? No. So we can't make them happy, but we can make them unhappy. What makes clients happy? Here's some trivia. What makes clients happy? Well, what do you think makes women happy? Or we all know what makes men happy. What makes men happy? Booze. Yeah, well, that's what it is. Sex is number 1 for 4 out of 10. Victory of their favorite sports team, 3 out of 10. That's what makes men happy. What makes women happy? This is sad. I'm sorry, that's not sad. Being with family is what makes women happy, and losing weight, that's what's sad, is what makes them happy. What's missing from both those lists, guys? What's missing from both those lists? Yeah, money. Money doesn't make people happy. Now, will lack of money make people sad? Yeah, I mean, if you're poor, that causes all sorts of stress. But are we working with poor people or people that have enough money to live a comfortable lifestyle? We're working with people that have enough money. So giving them more money isn't going to make them happy. We have the worst jobs in the world. We can't make our clients happy, but we can make them unhappy. Because guys, they don't get that much, they don't get happy when you make them 30%, but if you lose them 30%, what has now just happened? You made them unhappy. And guess where that unhappiness is going to be channeled? To you. So question, are all the people who have money happy? Do all the happy people have money? There's one way that money brings permanent happiness, and that if it brings you out of poverty. If it brings you out of poverty, that will bring you happiness, or at least allow you to be happy. But here's the funny thing. There's little difference reported in happiness reported between people making $36,000 to $145,000. And here's what they found. Once you make more than $500,000 a year, guess what happens to happiness? It goes down. And there's all sorts of reasons for that, but it goes down. So is your client's goal in retirement to enjoy family, enjoy traveling, enjoy friends, explore their faith, and leave a positive mark on earth? Are these the things that they're after? Or are they after trying to become rich? Which one? This? Or this? Which one? Is money that makes them happy? Or is it the financial security that allows them to be happy? See, connections make you happy, but lack of money can make you unhappy. Stress, worry, loss of sleep, getting a job. And lack of money means it could be real lack of money that you're poor, or it could be somebody who's well off that just what? You know, there's a true story about a guy. He was worth $5 billion. His company was worth $5 billion. He lost $4 billion, and guess what he did? He said, how much money is, okay, so he was worth 5, lost 4, what's he worth? High math, guys. He's worth $1 billion. Guess what he did? He committed suicide. Because, dudes, losing money is not a good thing. So it's not so much the money as what the money does for us. So should your clients' money run their retirement, or their retirement run their money? What do I mean by that? Should they try to hey, if they lose 30, should they invest their money to the point where if they lose 30, 40%, they have to stop? Well, look at it, these people that retired in 2000. In 16 years, did they keep ahead of inflation? So if they were living the life, guess what? They would have been in trouble. So do they really want the highest return with the least amount of risk? A return that gives them what they want without the risk of losing what they already have. Isn't that what they really want? Are they willing to risk everything for the chance to win something twice as big? So guys out there right now that as assets, as money managers that have all their clients' monies in stocks and bonds, what are they frickin' doing for their retired clients? Well, let me ask you this. How would you like to be next door, knowing what you guys know, how would you like to be next door to that guy and see all of his clients walking in and out? What are you going to be doing with your chops when you see that guy next door to you, all of his clients are in stocks and bonds? Yeah, you're licking your chops, exactly right, because you know what's going to happen to that guy. You know, my son's graduating from college here in a week, and he's going into financial planning. Guess what I told him? First of all, he knows all the 5Q communication skills. Actually, he's been learning all of those skills in college. They teach the skills I'm teaching you guys right now are the skills that they teach in college right now about motivational interviewing, about social psychology, all those things. They teach those kids that coming out of school. And when he knows all of this stuff, guess what he's going to do to guys who's been in the business for 30 years with all of their clients' monies in stocks and bonds? He's freaking only going to be 22 years old. What do you think is going to happen to him within the next 3 or 4 years? He's going to kill him. So getting the most returns is not the most important thing. Risk matters. We can't just worry about safety. Return keeps us ahead of inflation. Sometimes. What do we find out about return keeping us ahead of inflation? How often does it do that? A third of the time. Hit or miss, right? Problems with any market investment, volatility. It's going to be, is it going to be there when you need it? Market goes up most of the time and down less often, but remember, 34 of the past 51 years, that's 67% of the time the stock market did not keep up with inflation. And guys, anybody that wants to argue with this, let's do that. I will fly there on my own dime. Let's get in front of all your clients that I'd be happy to present to those clients, and then let's see who wins that argument. Anybody want to take me up on that? How would you like to do that with any of the competitors in your town? Would any of you like to present just those slides to any competitor's clients? Would you be? Yeah, we'd all love to do that. But my guy's really good. He's not going to do that, guys. We've talked about this before. two Nobel Prize winning economists, 100-year track record. What happened to long-term capital management? They nearly sunk the world. Mutual funds, 90 to 90% of the time they lose to the market. Money managers, investing in last year's best money manager yields a loss of 18.2% a year. Guys, did you realize that? If you looked at all the money managers out there and you decided, I'm going to look at last year, so I'm going to look at 2016's money manager, the best one is the one I'm going to invest in. And then next year, I'm going to look back and invest in the best one from 2017. If you did that, you would have lost your average rate of return would have been a negative 18.2% a year. What does that tell us? What does that tell us? It tells us that what? Anybody who's beating the market is doing it how? getting lucky, but more likely taking huge bets on something. And when the bets work, yes, they're lucky. They bet on the right thing at the right time. But how long does that kind of betting work? Until it doesn't, which is what happened to long-term capital management. If you don't know what long-term capital management and you're managing somebody's monies, you are a hazard to your clients. You should Google long-term capital management and understand what happened to them. See, here's the thing. Ecosystems, building a building, a skyscraper, a computer system, a financial system, a banking system. How long do those things take to build? How long do those things take to build? Decades. How long does it take for them to be destroyed? One day, exactly. But the odds are in stock's favor. What do we find out about the odds being in stock's favor? Yeah, they do beat the market more often than not, but we learned how does that help clients that are trying to stay ahead of inflation? So should I risk everything on the odds? Should I say double or nothing? You know, how many people, if I say, hey, listen, how many of you would bet your house if I said, listen, we're going to flip a coin. Let's say your house is worth $500,000, and I said, we're going to flip a coin. If you call it right, I'll give you $1 million. If you lose, I get your house. How many of you want to take that bet? See, nobody would. Nobody would. But yet when it comes to other people's monies, guess what we're okay to do? Isn't it amazing that when we're managing other people's monies, we're okay with taking all sorts of what? Risk. See, other people's money, we can't do that. This is their livelihood. They spent 30, 40 years getting to the point where they've got a comfortable retirement. Do they want to risk any of it? Do they want to risk any of it for the hope of having more money than they have right now? Hey, don't get me wrong. They'd love more money. But do they, if they're given a choice between having more money or losing their lifestyle, which one are they going to choose? They don't want to lose their lifestyle. So just in case, riding with a helmet. You know what? We all grew up not riding with a helmet. I grew up riding with a helmet. Did you guys use a helmet when you were growing up? But now, if you see your kid riding with a helmet, what would you do? And in fact, myself now, when I ride my bike to work, guess what? I feel like what if I'm not wearing a helmet? I feel like what if I'm not wearing a seatbelt? We all grew up, didn't use those things, but now, guess what? It's crazy. How many homes burned down? We don't need to buy home insurance, right? Wearing a life vest in a boat. I'm not going to fall over in the boat. In the boat, geez, I mean, how many? All these things, we do them just in case what? Just in case. So if you'd invested $10 from 1928 to 2002, that's 74 years, in a buy and hold, $10. Look at that, $10 would have grown to almost $11,000. That's crazy. Now, if you'd missed just the 30 best months, you'd only have grown to 154. So stock managers, I always love to show this. You got to stay and hold, got to buy and hold. Of course, they're turning over all the time, right? So they tell the client they got to buy and hold, but inside that fund, they're constantly buying and selling, buying and selling, buying and selling. But you better, because look at what would happen. You instead of getting 11,000, you would have only grown to 154. Hey, I agree with it. But here's the thing. What if you just missed the 30 worst months? Your $10 would have grown to $1,317,000. So am I more worried about losing or avoiding the best months, or am I more concerned about missing the worst months? How about showing this to your clients, guys? Miss 30 best and 30 worst? So, miss the 30 best and miss the 30 worst. This is a demonstration. What's more important? Making sure we're in during the good times or making sure we're out during the bad times? What does an FIA do for you? Make sure you're out during the bad times. So Fleckenstein said it's not losing money that makes you rich. It's not losing money that makes you rich. It's kind of what Warren Buffett says, right? Rule number 1, never lose money. Number 2, never lose sight of rule number 1. The lesson here is we can't just be safe. We can't just pursue a high return. You know, if you're a 90-year-old, you got to be worried about you got to have all your money worried about inflation. If you're a 3-year-old, if you're a 90-year-old, you got to have all your money worried about the risk. If you're a 3-year-old, you have to have all your money worried about inflation. But we're worrying, are our clients nearer to the 90-year-old or nearer to the 3-year-old? So should they be more worried about risk or more worried about inflation? Yeah, risk. So obviously diversification makes sense, and you should use both return and safety tools. So do I want you to have all the clients' monies in out of the market? No. But we can't, our bond's a safe place to be right now, guys. And should we have more money in safe versus risk for our clients? They should be more in safe than risk. They need to have some money in risk for growth. Again, maybe not, since growth doesn't keep you ahead of inflation more than a third of the time, but you need to have that money there anyways, just for suitability. So guys, with this information, you should be licking your chops. Anybody that you know that all they're doing, if all they're doing, not that they're mixing assets under management with FIAs, but if all they're doing is assets under management with stocks for growth and bonds for safety, what should be coming out of your mouth right now? You should look like St. Bernards, right? Drool. You should be drooling. Make sense? So, guys, this is something I get on a soapbox about, because it kind of pisses me off that the vast majority, I'll ask you this now, how many advisors would pass this test? Of these 10 things, how many advisors would pass that test? And yet they're sitting there, what? Trying to tell their clients that they're going to be good managers of their money. So do you understand why I get kind of emotional about this? Our job is to protect our clients' money, to be good financial advisors. And we have guys out there, it'd be like a doctor who couldn't answer 10 basic answers about medicine. So do you understand why I get so excited about this and get on edge about this? And I hope you do too, because you're part of the good guys. You're wearing the white hats. You're riding the white horse. You're doing the right thing for the clients. And I'm sorry. I know, and Jeff will probably hop in here and say, don't say that, but we're the good guys. All the other advisors are the enemy. And they may not realize that they're enemy, but guys, even if they don't realize that they're harming their clients, is that an excuse? That's not an excuse. So guys, I hope this puts some fire in your belly to get out there, see more people, talk to people, bring on clients, because you know what? You are the good guys. You are the line in the sand between your clients and all the other advisors out there. So Jeff, what would you add to that?
Well, I would say the same thing. I mean, it's one thing to sit back and wait for the market to tumble and start scooping up assets, because that's going to happen. Eventually that's going to happen, and we don't know when. But when people are dissatisfied, they're going to flock to people who have a balanced approach, and that's you. But so many people are going to get hurt along the way. Wouldn't it be great if we could be proactive and help those people to avoid that? Because we're going to make out when it falls, but we should be out there if we really care about people. And everyone that I talk to says that they do. They really care about people. They really care about their clients. It's one of the reasons they got into this business. We need to be out there with the vaccine, helping them before the flu virus hits, and we need to be doing both.
So guys, I hope you forgive me for getting so wound up about this, but is this kind of information helpful every couple of months, just to remind us of why we do what we do for our clients? So I got one yes. Good. So you guys have we'll cut it short here, because it's just more of the same, but you get the point that I'm making here, guys. Our stock's the be-all, end-all when it comes to inflation. Our stock's the be-all, end-all when it comes to growth. They're not. So what you're doing for your clients is the right thing. So hope you guys have a great rest of the week, and we'll talk to you all next Monday. Thanks, guys.